to talk about more about adjusting journal entries. In my last video, I kind of introduced the rules for adjusting journal entries. You're always going to want to have those on hand. And also the different types of adjusting journal entries that there are. There are only 4 different types. There's 2 accruals, 2 deferrals. All right, so what I wanted to do for you today, you have to do for your homework problem 3-1A. I'm going to do problem 3-1B. I will also, for those of you that don't have that in your online textbook, I will take a picture of 3-1B. It's very similar to 3-1A, although it's not identical, so it's not going to, the answers aren't going to help you. But some of the journal entry types and processes will help you. So that's why I'm choosing to do problem 3-1B today. So it won't be long. If you have any questions after reviewing this, please email me, and I'd be happy to go over adjusting journal entries with you. All right, so I'm going to start. I'm on page 148, problem 3-1B. On May 31st, the following data were accumulated to assist the accountant in preparing the adjusting entries for Oceanside Realty. So all 1, 2, 3, 4, 5 of these, all 5 journal entries are all going to start with 5/31. Remember in my rules, they're always at the end of the period. So all adjusting journal entries are going to be the same date at the end of the period. In this case, the end of our period is going to be May 31st. The first one, it says fees accrued but unbilled. This is a perfect example of an accrued revenue, that first type, under accrual, accrued revenue. We've done the work, but we have not billed the customer. And so if we haven't billed the customer, how's the customer going to pay us, right? And so this is something, like I said, the work has been done, the revenue has been earned, but we haven't billed the customer yet. So fees earned but unbilled May 31st are $19,750. So we're going to debit accounts receivable. And credit what type of revenue? Fees. Okay, and we're going to use the amount that they gave us, $19,750. So let's take a look quickly to make sure we're following our rules. Cash is never used. We didn't use cash. We did it at the end of the period. We have one income statement account. That's revenue. Revenue is an income statement account. We have one balance sheet account. Accounts receivable is an asset. Why did I choose accounts receivable? Because our customers owe us. They may not know it yet because we haven't sent them a bill, but we've done the work. They owe us the money. This is the transaction we're going to make at the end of the period. Moving on, the second one. The supplies account balance on May 31st is $12,300. The supplies on hand on May 31st are $4,150. For this type of an account, again, this is going to be 531, I like to use the T account. So we're going to use the ledger account for supplies. And it basically tells us that the supplies balance is $12,300. So that's the balance that's in the account at the end of the month. However, we've sent somebody to go do a count, or we've counted it ourselves, and really, in our supplies balance, we only have $41.50, which means, quite obviously, that we've used some supplies. So we had $12,300 maybe at the beginning of the month, and now we're down to $4,150. So we need to account for, now at the end of the month, right, we're making things right. We talked about that and part of the rules. I'm going to debit supplies expense for the difference, and I'm going to credit supplies. So let me take the difference between these two. I think it's going to be $8,150. So put that in here. So if I have a credit to supplies of $8,150, right, debit on the left, credit on the right, and I have that in here, now I take the difference between these two, right? The difference is that $41.50 that was given, okay? And so I've used my ledger account, I've used my journal entries, my adjusting journal entries to make things right at the end of the period. Because otherwise, come June 1st, right, the next day of the period, you might have the same 12,300 supplies in your ledger account when really you don't have 12,300 in supplies because of your count. You actually have 4150. So you need to credit or decrease, right? Credit to decrease an asset, credit to decrease that supplies account. to make your account of supplies correct. How do we do that when supplies are used? We use an account called supplies expense. So remember, supplies when purchased is an asset, supplies when used is an expense. Moving on. Wages accrued but not paid at May 31st. Again, this is another example of accrued. This is actually accrued expense. It says wages accrued but not paid. So sometimes you pay your people every other week, or the 5th and the 20th, something like that. But here you are the end of the month, and they've worked for a period of time. We don't know in this case how many days, but we need to make things right. We need to put their expense of May, in this case, back in the amount that it goes to, or in the month that it goes to, even though they might not even be paid until June. Okay, so the amount is going to be $2,700. I'm going to debit wages expense. And I'm not paying them. It doesn't say paid, it just says accrued, and I'm going to credit wages payable. Okay, moving on. The unearned rent account balance at May 31st is $9,000, representing the receipt of advance payment on May of 3 months rent from tenant. Okay, so we're going to do this unearned rent account, another T account. Now, remember, unearned rent is a liability. So it appears that we had tenants that prepaid 3 months in advance on May 1st. So we're going to put that $9,000 not into a rent revenue account, but into an unearned rent account. We're going to put that on the credit side, credit to increase the liability. And so now we have the May 1st, right? This happened May 1st. So they paid us for 3 months in advance. And so here we are now, May 31st, and we've now earned one of those 3 months. So they prepaid 3 months on May 1st, but now here we are at the end of the first month, and we've now earned a third of that money. So I'm going to take that $9,000, divide it by 3, I get $3,000 a month. I'm going to come over here, I'm going to debit an account called unearned rent for $3,000, and I'm going to credit rent revenue for $3,000. So if I come over here, and to reconcile my T account, I put that debit in here, right? Debit on 5/31, and then I go to reconcile at the end of the month. I take the difference between these two. I get $6,000 at the end of the period. In this case, at the end of May, I have $6,000 in my unearned rent account. That's $6,000 of a liability. Why isn't it 9? Because I earned one of the 3 months, and this is the journal entry that shows earning that. All right, one more. Depreciation of office equipment is $3,200. So we talk about depreciation more in Chapter 9, but they do introduce it in Chapter 3 as an adjusting journal entry, which it is. At the end of every period, usually end of quarter or year, I know this is a month, you would adjust all of your assets that are depreciable using depreciation expense. It's always, always, always the same debit and credit. So again, 5/31, I'm going to debit depreciation expense. So depreciation expense is always debited. And I'm going to credit an account called accumulated depreciation. Accumulated depreciation is actually a contra account. Contra means to take away from another account. So this accumulated depreciation account for this asset, office equipment, is going to be taken away from office equipment. So I'm going to credit accumulated depreciation. But then I'm going to write comma the type of asset that it is. In this case, it's office equipment. If I had more room on the first line, I would do it, but I used 2 lines. And the amount that they told us was $3,200. So that's going to go here as a debit to the expense and also a credit to the contra asset. For now, you just need to know what to debit and what to credit. Once we get to Chapter 9, we'll talk more about that contra asset it's attached to the asset of office equipment. So once again, we did all of this problem, all of problem 3-1B. We're done, but I want to review quickly. We had 5 different journal entries. That's probably pretty common. Even big companies only have maybe a dozen or so adjusting journal entries, and they're quite often the same ones at the end of every period. You adjust for the revenue that you've earned you haven't billed, you adjust your supplies, you adjust your employees who have worked during the period and haven't been paid. You might have some prepaid, like somebody's prepaying you or you prepaid somebody else. And then of course all your depreciation accounts. In this case, they just had one depreciable asset, so we only had one depreciation expense. Once again, we didn't violate any of the rules. They were all dated at the end of the period. None of the cash was used, not one time, and every single one of them had one income statement account and one balance sheet account. Adjusting journal entries are tough. I would suggest that you review the chapter thoroughly, that you look at the end of the chapter problems and exercises, and that you please ask me any questions. I'm happy to help you with them. See you next time.